Welcome to episode 17 of the Corporate Real Estate Insider Podcast. I hope everyone enjoyed our special episode last week with Maggie from Halliburton. What an awesome conversation. We will be covering a few interesting news stories today on episode 17. Brian, I know you've got a lot to talk about today. Let's start with you.
Thanks, Tucker. So the story I saw that was pretty interesting is, and I think it hits every market where our listeners are. If you go into any urban or suburban market, you see cranes. There's a lot of construction across North America. And most of it, or half of it, or some of it is multifamily construction. And there's been a trend, obviously, with rents growing. I think they peaked in 2021 at 18% rent growth. So there is a ton of pressure in the markets around the affordability of housing. Rent growth has been overwhelming in many markets. Well, apartment rents, I just saw this report come out, apartment rents went negative July over July for the first time in a long time. It was 0.7% negative. Vacancies are up to 7.3%, surpassing actually the peak during COVID, the June of 2020 COVID peak. And there's a massive amount of inventory coming online around the country. So where are we heading from here around the apartment market? If you listen to the other side of the equation, I was listening to an interview with Barry Sternlicht recently, and he's talking about the expiration of the debt that was used to construct all of these buildings. And there's another storm brewing around the expiration of the debt that sits underneath all of these new apartment complexes and apartment buildings. So is the residential market going to come back to earth, and where do we see it? Where do we see it? How does it fit into the big overall puzzle around defaults and the turmoils in the credit markets?
Hey, Brian, let me chime in. I actually found a few different articles that are tangent to the multifamily conversation. I think it's fascinating. The first one is this article titled "A Policy Overhaul That Could Aid Commercial Real Estate." And it's this idea that at the local level, there's all these rules around zoning and use, commercial, multifamily, and they don't really like commingling those. But of course, now we're trying to commingle those. We want mixed use and we want that conversion. So we're going to have to update and modify some of the local land use and zoning rules, which really begs an interesting question. Like, what was the intent originally around civic design where, okay, all the office jobs are going to go here and all the homes are going to go here, and you can't build office in the residential area and you can't build homes in the office area. But I think that was a failed premise. Now we want to sort of live where we work, don't we? Okay, so maybe a policy overhaul or a bunch of policy overhauls at the local level.
And John, just to pause there, I'm working on a project in Vancouver, and this is on that note. They have, if anyone has been to Vancouver, it's just one of my favorite cities in the world. It's a beautiful city. Well, they have a policy where, and this is Vancouver proper, specifically speaking about Burnaby, the city of Burnaby. But they have a policy where if you're a residential developer and there's a huge demand for residential, you have to build a podium office space as part of your residential development. And if you go back to the city and looking for more height, more units, they force you to build more office on the podium. So they're forcing through government, really good, I think, well thought out government policy, bringing those two uses together. We're actually at our sales meeting this week or last week, and we were talking about this. You're starting to see it. So in Boston, there's a number of new Millennium. There's a new Millennium Tower. They forced those two uses together, and there's a couple other ones that are in planning right now. But I think that is it could be a trend because it just makes sense. Live and work, bring them together in an urban environment. So it's and it's not. It seems so simple, but there's not a lot of good, at least in my world, not a lot of really good development that has successfully done that and on a wide scale.
Interesting to hear you say you had a sales meeting. I haven't heard about a sales meeting in a long time. It flashed an image of Glenn Ross. So yes, and interesting article title, U.S. office space on track to shrink for the first time on record. the amount of office space in the U.S. declining for what is likely the first time in history. They credit it to these conversions to multifamily and to the demolition of the obsolete office buildings like we've been talking about on this pod. So something's happening there. And you're talking about the demand for multifamily. Okay, this morning in CoStar, West Coast cities slam brakes on housing production amid worsening crisis. Let me read to you. Fewer multifamily projects have broken ground this year from Seattle to San Diego in one of the slowest starts to apartment construction in a decade. In San Jose, no apartments have broken ground after more than 7,000 started construction last year. In Seattle, 3,433 apartments started building in the first 6 months, a drop of nearly 60% from the same time last year. So maybe it's not the savior. If there's no, is it overbuilt? You're going to convert more when the multifamily folks are saying hit the brakes? Interesting.
Well, it's akin to the life science boom, in my opinion. Like during COVID, everyone was rushing to do a life science conversion. And some worked out. I don't suggest otherwise, but some have not. And they were too late to the game. And I've seen it happen before in Seattle with even office development. When the market gets to, sub 10%, vacancy, developers are rushing to build product. And the first ones out of the ground with good locations, good buildings tend to have success. And then there's always a few stragglers that come in late to the game, and that's when the market starts to correct. So none of this is not reminiscent of the playbook we've all seen happen with all asset classes for the time we've been in this business for decades. So what I can't predict is the future, but what you're telling me, John, sounds just like what I've seen with all asset classes over the course of my near 20-year career.
I think the key difference with housing, though, is that in likely many of these markets that you're referring to, I mean, certainly if we're talking, Los Angeles all the way through Seattle, there's housing shortages in probably the majority of those cities. And I think that the issue is just building new construction, super high-end apartments with all kinds of amenities, trying to push rents, trying to capitalize on having unprecedented rental growth continue for another 5 years, just as it has over the last 5 years, is simply not realistic. Yet we still have a housing shortage. So how do you reconcile those two things? Whereas, the demand for life science space has fallen off of a cliff, right? And that occurred at the same time that we saw this unprecedented boom in the amount of supply. I think the key difference is that the demand for housing is still very high, and now supply is going to fall. So it starts begging the question of what actually happens here in these cities that have major housing issues, specifically around affordable housing, not necessarily like affordable units per se, but just units that are less expensive, which tend not to be new construction. I think that we could find ourselves in a pretty uncomfortable situation with a worsening housing crisis, given the dramatically reduced construction starts. I mean, 7,000 units, built or under construction or started construction last year in San Jose by now, and this year it's 0. It's really not a good sign.
Yeah, it would be interesting to see the statistics, John, of those under construction. How many are the high end that Tucker referenced, which for many people are out of reach financially? How many are low income, which serves the bottom third, maybe bottom quarter of the population? But where's the ones in the middle that serve just the middle class? I don't see many of them here in Seattle. It's not to suggest they're not happening down south in your neck of the woods, but that would be a really interesting statistic to see if one exists.
I think the fundamental issue with this is just the regulation that exists generally in these West Coast cities that this study is referencing has created so much pressure on development costs that it's really challenging to actually build, right? The policy idea of, hey, let's create all these restrictions, let's have all these permits, all these different things, does not promote development, and it certainly doesn't promote affordable development. So I think it is a little bit funny where you have these policymakers in, at least before kind of the zombie apocalypse wasteland that San Francisco has turned into at times, over recent years. But you had policymakers sitting there saying, why isn't anyone building more apartments? This is crazy. We have this massive housing shortage, not realizing that it's their own policies that has made it completely uneconomical to build these things.
Yeah, I'd like to think there's going to be a market-based solution. Markets tend to be pretty efficient. And I'll even take a flyer and throw you an idea at the risk of being ridiculed. Wouldn't it be cool? So as I think about all this multifamily that's been built and this massive portion of our country that is a renter class, I mentioned it before on this pod, how owning your home is a source of wealth building for a vast majority of Americans. And yet this renter class is frozen out from any of that. They just pay rent. And these landlords make money as the values go up. Landlords, that harkens to peasants and serfs when you have landlords. Well, maybe one of these multifamily operators comes up with a plan that says, hey, renter class, when you rent in our building, you get a little LP interest in the development. You participate in the upside so that all this rent you're paying isn't merely going to rent.
I think that the issue around housing is another consequence of 500 basis point increase. There's going to be a pullback in construction because the numbers don't pencil out, and I think the concept of building affordable housing would take away the actual term affordable or the proper term affordable. You can't build affordable housing when construction costs are skyrocketing, land costs are skyrocketing, and now cost of debt's skyrocketing. It just doesn't happen. So the only way you're going to get anything affordable is the existing inventory that's on the market doesn't have the appreciation that the new construction has, and you need to replace it with something new. So the people that can't afford it will go lease it, and the rest of it can stay hopefully at a lower price point. That's in my mind. And if you have a market where all those factors are working against you, we're going to have, and we've seen it, development cycles will slow way down. There'll be a buildup of demand. Pricing will skyrocket again on the rental side, and then they'll come back and they'll start building again, hopefully when some of those factors settle down. But it's, to me, you look over the next 3 to 5 years, there's going to be this issue is going to get worse, not better. I think the cost of debt is an issue that's like, look at Yellow, the logistics company that just failed yesterday. It's 20 or 30,000 jobs, massive. I mean, they were as important into the United States that they received, what was the number, $700 million bailout during COVID, right? So they were deemed a national interest, to our economy, and they receive a bailout. A few years later, the debt that's sitting on their balance sheet is so cost prohibitive, the company fails. Is effectively the number one reason that they failed, is from what I'm reading.
Did you see, Brian, regulators came back later and said that was a mistake. They should not have qualified for the $700 million loan. They were not vital national security interests.
That's, of course they said that because they're trying to save their jobs, I bet. But they qualified at the time. But that's another consequence of this rising cost of debt. And think about how many companies were either acquired or how many acquisitions were made for larger companies with these huge debt service numbers on their balance sheet, that they are continuing to see the cost of that debt skyrocket as interest rates went up. So I think there's just a lot of consequences of the interest rate environment we're in today that we're not all looking at, and real estate is a big piece of it in a lot of different ways.
But I also think you look at a company like Yellow, there are a lot of companies that are sort of right on the bubble, right on the margin, where the rise in interest rate wipes them out. But they weren't exactly crushing it before. They've been sort of bumping along and struggling for years. They're trying to be a low-cost solution provider, and the formula was barely working. And so, yeah, the interest rate wiped them out. But that's sort of a natural cleansing effect of market cycles anyway, I believe. Hey, since you brought up rising interest rates, I have another article. And just a reminder, maybe everybody already knows this, but like this banking crisis isn't over. It's just out of mind, and it's still coming. It's like a train wreck in slow motion. My article says, who's this from? Market Watch, $1 trillion wall of worry, commercial real estate spiraling through 2027. I think it was $1 trillion just by the end of 2024. Although I heard you, Brian, say you thought it was $1.5 trillion. Like, this is coming. And it's in addition to all these unrealized losses that the banks aren't required to mark to market. And you mentioned regulators earlier. Thank goodness they're coming back to their jobs. They weren't paying attention to Silicon Valley Bank at all. But now it appears that they're starting to pay attention. I just remind us all that like this banking thing is going to play out over time. It hasn't gone away. And we're going to need to address what we do with bank deposits, regional banks. And do we all just flood to the big four? I mean, this is a problem that's still hanging out there.
You speak about the regulators, and they did come out with a 90-page document. This is in the Wall Street Journal for anyone that wants to look at this a couple of days ago, about that tidal wave you talked about, John, of these loans that are coming due. And the funny thing is like it just sounded like 2008, 2009 all over again, where they had a 90-day guidance on what to deal with these banks, and then suggested in part that they are advocating for short-term workouts. There's no doubt that there's a lot of loans coming due. I think the number was $1 trillion for the balance of this year, inclusive of next year, which is crazy. But I mean, there's no question the market is suffering. There was 61% less commercial real estate sales in 2023 through May, only 130 billion, which seems like a lot of money, but that was 61% less than what we saw in 2022. The thing that I have, and the reason I'm so skeptical that this is going to work, this whole what they used to call blend and extend or blend and pretend, is that the conditions today are a lot different than what they were in 2009. Okay, for starters, interest rates were way lower than they are today. Okay, that's not going to change. And then secondarily, unemployment was a lot higher back then than it is today. And so there were tens of thousands of office jobs added, which helped reduce the office vacancy back then. That's not happening now either. And so go ahead and, blend and pretend, there's still some rent coming in, but the office market is so different now than it was back then where, there was hope then. Now the hope that, these banks and these landlords have to, have is that somehow we're going to erase all of the work from home, work remote, whatever you want to call it, that became so prolific during the pandemic, that all of a sudden just gets wiped out. There's none of it, or very, very little of it. And well, yes, there are people coming back to the office. I saw a report that, Jones Lang LaSalle came out last week saying that there's going to be millions of people coming back to the office next year. And, we're about to see a huge surge of leasing. Who knows if that's going to even occur. But the point being is that I don't think the fundamentals yield much hope for those banks that do try and extend loans. I mean, yes, maybe you could argue that a default is worse than just getting some kind of money because the buildings aren't completely empty. There's some cash flow. But again, given the interest rates and given unemployment where it is today, I'm not long on the loans for these buildings getting reworked in a positive way.
I've said it before on this pod. I'll say it again. I think we need to return to boring banks. In terms of what the solution is, do we increase the FDIC limit again? And if so, how high? Do we backstop 100% of deposits? And if so, do we let these banks go make these speculative long-term investments when they're dealing with short-term, deposits that could be called overnight? So if you think about it, where do you put your money? Okay, if you got money at Schwab, that's not FDIC insured. What's the difference, right? But these stock brokerage accounts hold your money one for one. They actually have the money, unless they're breaking the law. They hold the money one for one. Your money is there when you put the deposit there. And as opposed to the banks, which are foundational to the way our economy works, that can loan out, 90% of the funds that they take in. And sort of the momentum effect, the compounding effect in the market, and the liquidity in the market. But again, if we're going to let them, if we're going to guarantee their deposits, man, we can't let them gamble with the money, says me.
I want to just go back to Owen's comment because it's JLL coming out. I was going to, as you were talking, Owen, it popped into my head because I saw the statement. They went so far as to say, and I think this is the same mindset that lenders and landlords have when they're extending these loans and just taking the cash flow. But they went so far as to say that they believe office occupancy will return to pre-pandemic levels by the end of 2024. And I think that is I hate to use the term laughable, but I think it's laughable because no one I'm talking to, maybe on 2 days a week or something, but if you look at it on a 5-day work week, there's just no way. I don't think we'll ever go there. And I think it's the same with owners and lenders. Lenders are happy to take cash flow because if the landlord defaults, hands back the key, they have to pay all this money to try to create that same cash flow. The operation is still in place. They're going to have to deal with the tenants. They're going to have to figure out how to operate the building, and it's just going to spiral over many assets. So I'll take the cash, keep paying it. It worked before. Let's just see how far we can get this and how long we can forget about it until we actually have our moment where we need to figure it out. And that's going to be somewhere down the road, probably when the cash flow on the landlord side gets so bad that the landlord just throws the keys on the table and runs away. But the firms that work with owners, the owners themselves, the banks are all telling a story that to me doesn't align with the realities of the marketplace and what tenants and what users of these buildings are actually doing and saying. So it's I think that reckoning is coming, and it'll be, unfortunately, it won't be this year, or fortunately, depends how you look at it, but it'll be before the end of next year, would be my guess.
McKinsey did a study of estimating market decline, commercial real estate market decline by 2030, and moderate scenario, it's a 26% decline in values. A severe, it's a 42% decline in values. And so compare that against what your typical LTV, loan to value of these loans is 70%. If you've got a 70% loan and the market's down 42%, you're underwater.
Client, and I'm going to probably butcher the way he says it because he says it a lot better than I, but he has said for many years now that owners in brokerage shops have forgotten who the real value comes from, and it's tenants. And he said, I think we're about to return to a period where we actually get a seat at the table again, and all the smart people aren't in the room anymore because we add all the value in these buildings, and it's so true, and I look forward to the day that it's here.
Totally agree. I forgot one of my key points on that 26%, 42%. If the market value is down 42%, you've got 70% loan to value on average. It's not just the property owner that's underwater. The bank's underwater by that 12% plus transaction costs to get that asset off their books. So watch this space. I've got one more. I don't know if other people have other articles, but you guys named some names of some of the big brokerage firms. This one caught my eye. It came out of CoStar just this morning. Newmark earnings drop 86% on declines in lending and real estate sales. Wow. Is that bad? That doesn't sound good. Okay, except let me continue reading. But the firm, the second large commercial real estate broker to report second quarter earnings, is holding to projections made in February that it expects $425 million in EBITDA and $2.5 billion in revenue for 2023 because it's betting that the steady increase in interest rates is over the past year, that it will ease. Let me say that again, that the steady increase in interest rates over the past year will ease. Here's a quote from the CEO. As interest rates stabilize, capital market activity will begin to rebound towards the end of the year. He goes on to say, we expect there will be a robust back half of 2024. And then they compare it to CBRE. That outlook is more bullish than projections by CBRE Group, Inc., the world's biggest commercial property brokerage, which cut its forecast as earnings fell 57% in the second quarter.
It just seems very unrealistic to, I would think, probably 95% of people in the industry to think that the second half of the year could be so crazy strong that it could make up for the first half. I agree that the second half should be significantly better than the first half. If nothing else, it's simply a reversion closer to the mean. We had a very, very multiple standard deviations away from normal first half in terms of building sales. And if it just is slightly less extreme, it will be a lot better. So I think that's a very safe bet to make. But for it to go from one of the worst periods for building sales, like in terms of total volume of sales, to one of the best periods, enough so that it outweighs the very bad first half of the year, I think is just incredibly unlikely. And as John said, perhaps he has information that we don't know about, but I think it is unlikely. And yeah, I mean, one other thing to consider is that CBRE, in terms of how it is capitalized versus how Newmark is capitalized with a very significant amount of debt, I could see them feeling that they would be punished a lot more for providing revised earnings versus CBRE, who has been a staple and sort of rock, the least likely of any real estate company in a very cyclical period to have any like going concern or debt default risks or anything like that. Not that Newmark does, but I mean, if this continues and earnings continue to be down 86%, that obviously isn't sustainable.
Newmark share price down 36% over a 1 year period and up 1% today, compared to CBRE, which is down 1.5% on a 1 year period and up 0.9% today. So both are up the same amount today. So I'm not sure that's a result of the comments. But CBRE year to year, only down somewhere between 1% and 2%. Pretty crazy. While Newmark is down 36%.
This all brings me back to spending many years inside these publicly traded companies and the pressure that gets put on the tip of the spear brokers on the capital market side and on the tenant rep and landlord side, any brokers, around generating fees when the company needs it, right? So I just caution anyone listening to look at it through the lens of, if you're working with on any part of the business, if you're working with one of these firms, the pressure on these people that you're dealing with to generate fees today is unreal. It is probably higher than it's ever been in their careers. So it's you got to look at things through the lens of who's providing the information, I think.
Not to mention their own personal motivation, given that property sales are down 61% over last year, Brian. People have to make money. So their own personal pressures as well, not knowing their own financial stability within their household.
Exactly. I got to tell you, having this approaching my first year out of those organizations and working at Hughes Marino, it couldn't have come at a better time. So it's a difficult time to be in those organizations. And I'll tell you, I just had a very good friend of mine, someone I've known for over 20 years or right around 20 years. He was he's a very talented commercial real estate person on the account side. He's a CPA and super smart. I just learned that he was let go out of one of these organizations as part of a wider downsizing. So it's a people side. It sucks, but those organizations are in a tough place. They even have to let the good talent out the door if the in previous cycles at different times, what they do is they put you on the bench. We used to call it the wheel. And you just, if you come off an account or an account changes, you get put on the bench, and then spin the wheel, gets put on a different account, and they continue to retain that talent. Here, they let people that are really talented real estate people walk out the door. So it's I'm sure it's happening all across the country and the world. So it's a scary time, because then there's people that are out of jobs in an industry that's really hard to probably find a job right now.
So, Brian, and I'm sure you're seeing this too, and in fact, we've seen this on projects that we've worked on together, as I have with Owen and John. We probably will see it together sometime soon. I'm sure you're already seeing it, but the level of real estate execution that is happening at a lot of large organizations seems to be deteriorating, and I think it's a combination of these companies cutting costs and having less people supporting these accounts, or maybe less committed, more work from home, more laziness, whatever it might be. And then also it seems that so many of these organizations are cutting costs, and it leaves somebody in a director of real estate role at a company. And this, of course, is not all companies, just we've been seeing more of this lately, where you have one or two people doing the work of 5 or 10, and then their partner that's supposed to be supporting them may not be supporting them as well. It's a really challenging situation. I've been working on a project where we literally can't get a response from a very large company. Everyone would know the name of this company, which we won't say. And our client is trying to sublease space from them. It's a multi-8-figure transaction. And we can't even get a response from this company because they are so disorganized. And this is space that they are actively trying to dispose of, that they effectively should not even have on the market because they're incapable of making a deal. And you start thinking about the amount of organizations that have major challenges within their real estate department. I was on another call earlier today with Brian, and we were talking to, incredibly bright person, have a ton of respect for, who is a superb person in this director of real estate role, has some limited support, and isn't able to get into the place of playing offense, right? Isn't able to use the strategic, hey, this is highest priority, let's do this, let's do that, this is what we're focused on as an organization, because they're just trying to catch up, just trying to, keep leases from expiring without, getting kicked out of buildings or whatever might happen. So it's really interesting that in a time where companies are more focused than ever on saving money, that so few of these real estate departments are being supported properly in order to actually execute on that on the real estate side of things.
At a time when everyone's talking about their real estate, like almost every company has some dynamic elements to their real estate. Maybe they need 20 or 30% less. Maybe they're paying 20 to 30% above market. There's been this big seismic shift. So everybody's thinking about it, but they're not.
Yeah, and there certainly are some bright spots in here of companies that are doing a phenomenal job. I mean, if you listen to episode 16 released last week with Maggie, who is in charge of real estate for Halliburton, and I noted this on last week's episode with Maggie, but it sounds like Halliburton is one of the most well-run real estate departments of any Fortune 500 company around that we've talked to and seen. So there's certainly people out there that are doing a great job, but I think there's a large percentage of these, corporate real estate departments that are overworked, understaffed, and having a really hard time being strategic. And when you can be strategic, that's when you can unlock these really large opportunities for savings versus just being reactive and just, trying to renew leases and, do expansions, respond to estoppels, and just kind of doing the basics. And if you can do the basics super well, then I think you have the opportunity to step up and do things that can be transformative for an organization.
Yeah, and I find it funny when people lay people off within an organization on the real estate team for the sake of savings and labor costs, figuring that one person or maybe two can just handle putting out the fires. And like you said, renewing leases, extending leases, moving when they have to. But if you look at the balance sheet, for most companies, real estate's the second biggest line item. So why would you, I don't know, just a funny question, but why would you lay people off that serve the second biggest cost to your organization that truly can pay for themselves many, many times over by being strategic and helping find ways to optimize savings and be more efficient with their real estate spend? It just doesn't make sense. But that's where, for our sake, we're doing that for companies right now that are limited with resources. And that's what's been kind of the most fulfilling part of my job over the past couple of years, is being able to help companies that don't have the resources internally generate the savings that's meaningful to them to help shore up their bottom line.
100%. I agree. Both things. They're laying people off, but they're also not allowing these organizations to bring on the resources that they need, right? There's hiring freezes, or just, they're taking on, a particular person we were speaking with had the role of M&A and real estate. And it's a massive organization with hundreds and hundreds of locations. And those are two jobs that could use a team around each of them, certainly two people. And, it's budget constraints, it's concerns about the future economy. And I think there's no time that in my career that I've seen where companies need more than a broker. They need smart people that understand real estate. The execution, can be the easiest part if you figure out the strategy, understand your organization, understand needs. and ultimately the execution comes when all that's figured out. It's the easy part. And at no time in my career with so many internal and external factors on all asset classes. I mean, if you look at the office market, that is massively being disrupted. Industrial, massively disrupted. Life sciences, growing like crazy, massively disrupted on the upside with the lack of space, and now on the downside with 80 subleases in Boston, over 2 million square feet of vacancy kind of overnight. So there's just, it doesn't matter what portfolio you're running, there's disruption and just the need for really good, smart teams to help figure it out more than ever.
Shout out, you mentioned getting back to basics. Shout out to our friend Joe Calloway. He's so good at the basics, they become cutting edge.
Let's wrap up with that. Thanks for tuning in to episode 17. We really appreciate it, and we will be back again soon.